Welcome to Alfred Kazin Notes, a place where literature, ideas, and the minds of great writers come alive. Let's explore the thoughts behind the words. Today, we are looking at a landscape where, algorithms can vaporize $1 billion in a literal microsecond.
Yeah, just in the blink of an eye.
Right. And in this hyper-connected financial world of 2026, intelligence is, it's actually your biggest liability.
I mean, it really is. People think raw brain power or, advanced calculus is going to save them.
Exactly. Or some elite Wall Street pedigree. But if you think that'll save your portfolio from the chaos of modern markets, you are stepping straight into a trap.
Oh, absolutely.
It feels less like an economy now and more like, an algorithmic echo chamber where one single rumor triggers 1 million automated sell orders before a human being even blinks.
Yeah, the machines just take over.
Right. So to survive this, we are opening up a psychological anchor today. We're doing a deep dive into Benjamin Graham's timeless masterwork, The Intelligent Investor.
Such an incredibly vital book right now.
It is, and we're specifically leaning into the modern commentary by Jason Zweig and, of course, that legendary preface by Warren Buffett. Our mission here is to dissect Graham's absolute core philosophy, which is, and I'm quoting here, investment is most intelligent when it is most businesslike.
That specific word, businesslike, that is the entire architectural foundation of Graham's worldview. He isn't offering some, mathematical formula to beat algorithmic high-frequency trading.
Right, because you can't beat that anyway.
Exactly. He is offering a psychological framework to prevent you from defeating yourself.
Yeah.
Because Graham recognized decades ago a truth that is just hyper-amplified for you today.
Which is what, exactly?
That the true chaos of the financial markets isn't embedded in the economic data. The chaos is entirely embedded in human nature.
Wow, yeah. And if we want to understand how terrifyingly irrational that human element can be, we really need to look at what the market did to one of the most formidable intellects in human history.
Oh, this is such a great example.
Right. Let's rewind to the spring of 1720, Sir Isaac Newton.
The guy who literally mathematically defined gravity.
The gravity, he invents calculus, right. And he owned shares in the South Sea Company, which was essentially the most speculative, overheated stock in England at the time.
It was a massive bubble.
A huge bubble. And Newton actually sensed that the market was detaching from reality. He famously muttered this line that he could calculate the motions of the heavenly bodies, but not the madness of the people.
I love that quote.
It's so good. So, operating rationally, he sold his shares. He pocketed a phenomenal 100% profit, which is like £7,000 back then.
So he executed the perfect trade, right? Based on a totally rational assessment of an overheated asset.
Right.
But the thing is, the mechanism of a bubble, it doesn't care about rational assessment. The stock just continued to skyrocket.
It just kept going up.
Yeah, and the psychological pressure of watching his peers amass all this ungodly wealth, it completely overrode his intellect.
FOMO. He literally got hit by FOMO in 1720.
Exactly. The fear of missing out grabbed hold of him and he capitulated. Newton jumped back in at a vastly inflated price. And when the South Sea bubble inevitably collapsed, he lost 20,000 pounds, which that translates to millions in today's capital.
Millions. And wasn't he so traumatized that he basically outlawed the company's name?
Yeah. The trauma was so absolute, he forbade anyone to ever speak the words South Sea in his presence for the rest of his life.
It's just the ultimate tragic irony. I mean, he wrote the mathematical laws governing how physical objects are pulled toward each other.
Right.
But he was completely defenseless against the psychological pull of a crowd making money. I think it proves Graham's ruthless definition of the divide between investing and speculating.
Oh, definitely. Graham is so strict on this.
He is. He insists that an investment operation must promise safety of principal and an adequate return based on thorough analysis.
Thorough analysis being the key phrase.
Exactly. Anything that falls outside that strict parameter is just, tossing chips onto a roulette table. It doesn't matter how smart the person placing the bet is.
Because intelligence in this arena is a trait of character, it's not a function of the brain.
That's a good way to put it.
Yeah, if you lack emotional discipline, the market will find your psychological fracture point and just dismantle you.
Right.
And look, if you suspect humanity somehow evolved past Newton's folly, consider the collapse of long-term capital management in 1998.
Oh, LTCM. Yeah.
This was a hedge fund managed by a literal battalion of elite mathematicians.
Yeah.
They had 2 Nobel Prize-winning economists on staff, Robert Merton and Myron Scholes.
Literally the smartest guys in the room.
Exactly. And they built what they believed was a flawless, mathematically invincible arbitrage system.
But they were operating with massive, massive systemic leverage.
Well, huge.
They weren't just making smart bets. They were borrowing like $25 for every $1 they actually held to amplify those bets.
Yeah, the leverage was staggering.
Wow. And their models assumed historical mean reversion-like, that the bond markets would eventually behave normally. But they failed to account for the mechanism of an actual liquidity crisis.
Right, because when Russian debt defaulted, the market didn't behave normally. It panicked.
It totally panicked. And because LTCM was so heavily leveraged, their collateral just shrank overnight, triggering margin calls they couldn't meet.
And they couldn't even liquidate their positions.
Right, because they essentially were the market at that point. Their raw intellect was completely crushed by the unpredictable reality of human panic.
And that failure nearly capsized the entire global financial system.
Yeah, it was a really close call.
It really underscores this terrifying reality that brilliant models break when they collide with the irrationality of the crowd.
Okay, so if brilliant people like Newton and, actual Nobel laureates are repeatedly crushed by crowd psychology, it forces a really uncomfortable question for anyone navigating the markets today.
Which is?
Who exactly is on the other side of our trades?
Oh.
And Graham actually gave that psychological phantom a name. He created what might be the most brilliant and unsettling metaphor in modern finance, which is the parable of Mr. Market.
It is a total masterpiece of behavioral economics.
Walk us through it.
So Graham asks you to imagine that you own a share in a private business. Say it's worth roughly $1,000.
Okay.
And you have a partner named Mr. Market. But this partner suffers from severe manic-depressive mood swings.
Like clinical mood swings.
Exactly. And every single day, without fail, he comes to your door and offers a price to either buy your share from you or sell you his share.
So on certain days, his mood is pretty stable, right? And the price he quotes reflects the actual cash flow and intrinsic value of the business.
Right. It makes sense.
But on other days, he is swept up in this wild, utopian euphoria. He's convinced the future is limitless, and he quotes a price that is just astronomically high.
Oh, yeah. Completely detached from reality.
And then, inevitably, his mood swings the other way into panic despair. He becomes convinced the economic world is ending. And he offers to sell you his share for pennies on the dollar.
And the mechanism Graham is exposing here is the total disconnect between price and intrinsic value.
Right.
Because if you are a prudent business owner, you would never let a manic-depressive partner's daily emotional outbursts dictate your own calculated view of what your enterprise is worth.
No, of course not. You'd think he was crazy.
Exactly. Yet in the stock market, millions of investors let the daily price quotes dictate their entire perception of reality.
Well, I have to challenge the application of this in our current era, though.
Okay, how so?
Because, in Graham's day, you had to actively seek out Mr. Market by, opening the morning newspaper to check the ticker.
True.
In the hyper-connected world of 2026, Mr. Market isn't just knocking on your door once a day. He is permanently embedded in our smartwatches.
It's on every screen.
Exactly. The financial media has gamified the entire ecosystem. We are subjected to push notifications, breaking news alerts, algorithmic sentiment trackers.
Yeah, it's a lot of noise.
It is an engineered behavioral Skinner box designed to make you react. So, isn't it almost psychologically impossible to ignore Mr. Market today when the architecture of the internet is basically forcing him upon us?
It is exponentially more difficult now, which is precisely why you must internalize Graham's central rule regarding this whole dynamic.
And what's that rule?
Mr. Market is your servant, not your master.
Your servant.
Yes. His daily quotes are a mechanism of convenience, provided strictly for you to either exploit or completely ignore.
Wow.
The true investor is never forced to sell just because the price drops, and they're never forced to buy just because the price is rising. You possess the absolute freedom to form your own independent calculation of intrinsic value.
Based entirely on the underlying business's balance sheet and cash flow.
Exactly. Just the fundamentals.
So when he is screaming in euphoria, you happily sell your shares to him at a ridiculous premium.
You take his money.
Right. And when he is sobbing in the streets, desperate to liquidate for nothing, you buy his share.
Yep, you buy the discount.
But the rest of the time, you simply shut the door and let the business operate.
Right. You observe the madness, but you completely refuse to participate in it.
But wait, if your business partner is this volatile entity capable of basically burning the building down during a panic, How do you structurally protect yourself?
That's the key question.
Because knowing he is crazy doesn't physically shield your portfolio. This requires a mathematical fortress, which Graham distills into the three most important words in investing.
Margin of safety.
Yes, margin of safety.
The margin of safety is the entire risk management engine of value investing. And Warren Buffett uses this visceral analogy in his preface to illustrate the mechanism.
The bridge analogy, right.
Yeah. So if you are engineering a bridge and you know the heaviest truck that will ever drive across it weighs 10,000 pounds,
Yeah.
you do not design the bridge to hold exactly 10,000 pounds.
No, because if a truck drives over it while there is, I don't know, a structural microfracture in the steel or a severe gust of wind, the entire span just collapses.
Exactly.
You engineer it to hold 30,000 pounds. You build in a massive buffer for the unknown.
And Graham argues you must apply that exact same structural engineering to your capital. You insist on never overpaying for an asset, regardless of the narrative surrounding it.
Right. Graham says you have to buy your stocks the way you buy your groceries, not the way you buy your perfume.
Oh, that's such a great line.
You always have to ask how much. You calculate the intrinsic value, like the discounted future cash flows and tangible assets of a company, and you demand to buy it for significantly less than that number.
Right. You look for a dollar bill selling for 40 cents.
$1 for 40 cents.
Yeah. And that 60-cent gap is your margin of safety. It exists entirely to absorb the inevitable blows of bad luck, or accounting fraud, or your own analytical miscalculations, or a sudden, terrifying macroeconomic crash.
Because mistakes are guaranteed.
Exactly. Graham fundamentally understood that the probability of making a severe mistake in your investing lifetime basically approaches 100%.
Yeah.
The margin of safety ensures that when you do make that mistake, the damage is absorbed by the discount rather than wiping out your principal.
But let me elevate this for a second, because finding a 40-cent dollar sounds great in theory.
Sure.
But we are operating in a 2026 market dominated by passive index funds and these high-frequency trading algorithms that relentlessly scrape every microscopic arbitrage opportunity.
Let me find every penny.
Exactly. So does that 60-cent gap even exist anymore? Furthermore, modern portfolio theory and the capital asset pricing model dictate that to achieve a higher reward, you inherently have to accept higher volatility.
Higher beta.
Right, a higher beta. The dogma of Wall Street is that risk and reward are perfectly correlated. Are you saying Graham mathematically breaks that correlation?
Well, he doesn't just break it. He completely inverts it.
Inverts it.
Yeah. That is the great paradox of value investing. Modern portfolio theory, you are taught to move further out on the risk curve to chase yield.
Yeah, to take on more risk for more reward.
But through Graham's lens, the exact opposite is true. If you buy an asset worth $1 for 60 cents, you have a solid deal.
Okay.
But if an algorithm-driven panic temporarily drives the price of that same dollar down to 40 cents, the conventional market views that asset as riskier because its price is highly volatile.
They see the price dropping and panic.
Right. But Graham recognizes that buying it at 40 cents is mathematically less risky because your buffer against further downside is vastly wider.
Wow, that is a staggering reframing.
It really changes everything.
So by demanding the margin of safety, you are essentially crushing your downside risk while simultaneously stretching your upside potential. The journey from 40 cents back up to intrinsic value yields a much higher percentage return than the journey from 60 cents.
Precisely. The cheaper the price you pay relative to the underlying intrinsic value, the safer the investment actually becomes.
But if the math is that asymmetrically favorable, it forces another question.
Okay.
Why do brilliant institutional fund managers and everyday investors continually abandon the margin of safety? Because it happens cycle after cycle.
Oh, it really does. And they abandon it because of the seduction of obvious growth.
The growth trap.
Yes, they become totally mesmerized by a macroeconomic trend and completely detach their analysis from the actual price they're paying for that trend.
It's the danger of paying for an impossible future. Let's examine the commercial airline industry in the 1950s.
Great historical example.
Yeah, if you were analyzing the world then, you didn't need to be a visionary to realize that air travel was going to completely revolutionize global commerce. I mean, the passenger growth was undeniable. It was a massive, obvious macroeconomic shift.
The revenue expansion was spectacular. It outpaced almost every other emerging sector at the time.
But if you bought airline stocks based on that obvious growth narrative, Your portfolio was decimated.
Wipe out.
And the mechanism of their failure wasn't a lack of demand, it was the capital expenditure. The technological arms race to build faster, larger jets combined with brutal price competition, it completely devoured their profit margins.
Yeah.
The airlines literally lost hundreds of millions of dollars while flying more people than ever before.
And we saw the exact same delusion, the exact same mechanical failure play out during the dot-com crash.
Right.
Consider the chilling example of Inktomi in the year 2000.
Oh, Inktomi.
Yeah, they were a pioneer in internet searching software. In March 2000, Mr. Market was operating in a state of absolute utopian euphoria. He priced Inktomi shares at $231.
$231 a share.
And the market capitalization hit $25 billion.
But to understand how absurd that is, we really have to look at the multiple. They were trading at roughly 250 times their revenues.
Which is insane.
Right. Mechanically, when you buy a stock at 250 times revenue, you aren't investing in the company's current reality. You are mathematically assuming they will capture an impossible percentage of the global market with flawless execution for the next decade.
You are literally pricing in perfection. And when you price in perfection, there is zero margin of safety.
Zero.
The moment the mathematical assumption drops even slightly, the valuation model breaks entirely.
And it did break.
Oh, completely. By September 2002, just 2.5 years later, Inktomi stock closed at 25 cents.
It collapsed from $25 billion to less than $40 million.
Yeah.
But I think the most vital piece of this autopsy is that Inktomi's underlying business did not evaporate.
No, it didn't.
They were still generating over $100 million in revenue. What changed wasn't the existence of the company. What changed was the mechanism of multiple contraction.
Well,
the market suddenly refused to pay a premium for a future that was no longer guaranteed. Yahoo eventually bought them for a fraction of their former peak.
and Graham anchors this reality with a profound warning that every investor needs to memorize.
What's the warning?
Obvious prospects for physical growth in a business do not translate into obvious profits for investors.
Say that again.
Obvious prospects for physical growth in a business do not translate into obvious profits for investors.
Wow.
Because by the time the growth is obvious to the crowd, the market has already aggressively priced it in. The higher a stock's price goes, the more risky it becomes. Enthusiasm on Wall Street is not a signal of safety. It is almost inevitably the precursor to disaster.
It perfectly illustrates the fatal flaw of projection versus protection. When you pay a massive premium for a growth stock, you are paying for a future that hasn't happened yet.
Right.
It's like paying $50 million for a barren plot of land based on a rumor that a Hyperloop station might be built next door in a decade.
Yeah.
If the zoning falls through, your capital is wiped out.
Which brings us to the ultimate synthesis of how to survive all of this.
How do we do it?
How do we anchor ourselves against the gamification, the algorithmic volatility, and the seduction of these growth traps?
Right.
We adopt the definitive mindset. We return to our mission statement. Investment is most intelligent when it is most businesslike.
That is the paradigm shift that neutralizes the chaos. A stock is not a blinking green or red light on a digital chart.
No, it's not.
It is a legal ownership interest in an actual physical business. You should not attempt to extract profits from securities unless you know as much about their intrinsic value as you would if you were manufacturing or dealing in physical merchandise.
It requires stripping away the entire casino atmosphere of the market.
Yeah.
You aren't trading a ticker symbol.
Yeah.
You are purchasing a fractional claim on a company's future free cash flow, its intellectual property, its inventory, its debt obligations.
Real stuff.
Exactly. If you wouldn't buy the entire commercial laundry business down the street without forensically examining their books, inspecting their equipment, and negotiating a rational price based on their annual profits,
Yeah, right.
why would you buy a multi-billion-dollar tech conglomerate just because a momentum algorithm pushed the price up yesterday?
It's the difference between betting on a horse race and owning the physical racetrack.
Oh, that's a perfect analogy.
When you own the racetrack, you don't care which horse wins the 315. You care that the gates are open, the concessions are selling, and the business is systematically generating cash.
And maintaining that perspective requires tremendous psychological discipline, especially when, your peers are getting rich quickly on speculative bubbles right in front of you.
Yeah, that FOMO again.
But the historical record proves the superiority of this method. Just look at Graham's own career.
Okay.
Despite all his quantitative analysis, the defining triumph of his portfolio was a single, deeply researched investment in an insurance company called Geico.
And he allocated roughly 25% of his fund's capital into that single entity, right?
He did.
Which seems incredibly concentrated for someone so obsessed with safety.
It was concentrated, but it wasn't speculative. He painstakingly verified that the company possessed a durable competitive advantage, which was their direct-to-consumer model at the time.
Ah, okay.
And he purchased it at a price that guaranteed a massive margin of safety. He understood the mechanics of the insurance float.
Right.
And that single, disciplined execution yielded more profit than all his other trades combined over 2 decades.
That is amazing.
That perfectly demonstrates that rigorous preparation combined with the patience to wait for Mr. Market to offer an irrational discount manufactures extraordinary luck.
So let's pull back and look at the entire architecture we've built here. Navigating the hypervolatile algorithmic landscape of 2026 requires internalizing 4 absolute rules from Graham's masterwork.
Okay, let's hear them.
First, remember the tragedy of Isaac Newton. Sheer intellect cannot save you from the gravitational pull of crowd psychology. Intelligence without emotional discipline is useless.
Absolutely.
Second, refuse to let Mr. Market dictate your reality. He is a manic-depressive servant offering you quotes, not a master dictating intrinsic value.
Flat on.
Third, demand a margin of safety. Engineer your portfolio with a deep structural buffer so that when you inevitably miscalculate or the macroeconomy fractures, your principal survives.
Yeah, build that bridge strong.
And finally, strip away the gamification. Treat every share as a fractional ownership in a living, breathing business.
The ultimate realization here is that the true risk isn't hiding in the dark pools or the high-frequency trading servers.
Where is it?
The risk is hiding in you.
Wow.
Your capacity to control your own neurochemistry when the market panics is the singular deciding factor in your financial survival.
Which leaves us with an unsettling thought to carry with you long after the audio stops today. We know from neuroeconomics that human brains process financial loss in the exact same neural pathways that process physical pain.
It literally hurts.
It physically hurts. We are biologically hardwired by millions of years of evolution on the savannah to seek patterns and follow the panic of the herd because isolation meant death.
Right.
Now, the math of value investing is flawless, but the lingering question is this. Does knowing Benjamin Graham's logical mechanical rules truly possess the power to override our own DNA? You can memorize the concept of the margin of safety. You can master the calculation of discounted cash flows. But will there always be a moment, perhaps in the dead of night during the next unprecedented flash crash, when the alarms are screaming and your portfolio's value is dissolving in real time, when Mr. Market finally finds the key to the door of your own mind?